Stocks are up, GDP continues to grow. Unemployment appears low, big companies continue to profit. News channels say that the American consumer remains resilient, that the economy escaped a major recession, and that perhaps people are just being overly pessimistic. So why do so many people feel broken? Why are millions of Americans working, earning a paycheck, paying bills, doing everything they're supposed to be doing, yet still feeling like they're getting poorer? Why does a salary increase no longer feel like an increase? Why does a trip to the supermarket feel like a financial decision? Why does paying rent, car insurance, mortgage payments, health insurance, gas, food, and credit card bills seem so much more burdensome than it did a few years ago? If you want to understand what's really happening in the economy, without political no's, complicated language, or explanations written for economists, subscribe to the channel, because that's exactly what we do here. Now, here's the point that almost no one explains properly. The economy may seem strong on television, but at the same time, it may seem broken inside your home. And that doesn't mean you're crazy. It also doesn't mean that all the data is false. The problem is that the data shows the economy from the top down, but you experience the economy from the bottom up. There is a huge difference between looking at GDP, the stock market, corporate profits, and the unemployment rate, and looking at rent, food, insurance, gasoline, credit cards, car loans, and medical bills. On average, the economy may appear stable, but averages hide brutal divisions. A person who bought a house years ago, with low interest rates, is living economically. A person trying to buy their first home today is living a completely different life. Those who own stocks, real estate, and financial assets live in a thriving economy. Those who only have a salary live a different life. Those who refinanced debt when money was cheap are now saving money. Those who are paying off credit card debt with exorbitant interest rates are living a different life. Those who have seen the value of their own home increase can look at the economy and say, everything is fine. Those who pay rent and see the price go up every year look at the same economy and think, something is very wrong. And they could both be right, because the economy isn't exactly lying. She is grouping together, on the same average, people who no longer live in the same financial reality. That is the great paradox. The American economy may be performing very well for those who possess assets, capital, real estate, stocks, and cheap old debt. But it may be working very poorly for those who depend on wages, rent, expensive credit, and basic consumption. So before asking whether or not the United States is in recession, perhaps the more honest question is another one. Recession for whom? Because the first mistake is thinking that the main economic indicators measure your life. They don't measure. GDP measures economic activity. It shows how much is being produced, sold, bought, and invested. The GDP doesn't measure whether you sleep soundly at night. GDP doesn't measure whether your accounts balance at the end of the month. GDP doesn't measure whether you're postponing a doctor's appointment because your health insurance plan has become too expensive. GDP doesn't measure whether you're choosing between paying your entire credit card bill or buying groceries for the week. An economy can grow, and yet millions of people can still feel financially crushed. The stock market doesn't measure quality of life either. When the market goes up, it's great for those who have stocks, funds, a well-invested retirement plan, and accumulated wealth. But if you don't own a significant portion of these assets, a rising stock market can feel like a party happening in a building you weren't invited to. You see the headline saying that the market hit a record high, but his bank account didn't break any records. Your rent hit a record high. Your car insurance policy hit a record high. Your credit card debt may have hit a record high. And that's why so many people look at the economic news and think, this doesn't sound like my life. Low unemployment can also be misleading. Having a job doesn't mean having financial security. Having a job doesn't mean you can buy a house. Having a job doesn't mean you can afford childcare, doctor, car, food, insurance, rent, and still save money. A country can have low unemployment and, at the same time, have millions of people trapped in jobs that no longer pay the standard of living they used to. This is the part that hurts, because, for many people, the problem isn't a lack of work. The problem is that work has lost its appeal. And here's where a simple idea from behavioral economics comes in. Money illusion. Monetary illusion is when you look at your salary number and think you're better off because you're earning more dollars than before. But what matters is not the number. What matters is what those dollars buy. An increase of $5,000 a year doesn't seem like an increase if the rent went up for $100 a month. A higher salary doesn't seem like progress if food, insurance, interest rates, transportation, and healthcare have all gone up at the same time. That's why many people are earning more nominally, but feeling poorer in practice. Because real life doesn't ask how much you earn on paper. She asks how much is left after everyone else has already taken their share. The supermarket takes a cut, the rent takes a cut. The insurance company covers part of it. The car takes a part, the doctor takes a portion. The bank takes a cut, the card takes a portion. And in the end, the average American looks at their own salary and thinks, I'm earning more than before. So why does it feel like I'm living with less? This is the question millions of people are asking, even if they don't know how to put it in economic terms. And the answer begins here. The economy appears strong because we measure strength at the top. But the pain is being felt at the grassroots level. The second mistake is to look at official inflation as if it were the same for everyone. She isn't. Official inflation measures an average basket of prices. But nobody lives within an average. Every family has its own inflation rate. If you live with your parents, don't have children, don't own a car, don't pay for expensive health insurance, and hardly ever drive, your inflation rate may seem lower. But if you pay rent, have children, need a car for work, buy food every week, pay for health insurance, car insurance, and credit card interest, your inflation may be much higher than the official number suggests. That's why so many people get annoyed when they hear inflation is falling. Because, technically, that could be true. But in practice, this doesn't mean that life has become cheap again. It simply means that prices are rising more slowly. If something cost $100, then went to $130, and is now rising more slowly to $135, inflation may be falling. But you're still paying much more than before. And your brain doesn't compare life to a government spreadsheet, he compares it to memory. Do you remember how much the shopping cart cost? Do you remember how much it cost to fill up the tank? Do you remember how much the rent was? Do you remember how much money was left over at the end of the month? This is called anchoring. People use the past as a point of reference. And when the present seems much more precious than that reference, the feeling is one of loss. And losses hurt more than the equivalent gains help. This is another point in behavioral economics, loss aversion. When your salary goes up a little, you adapt quickly. But when food, rent, and insurance go up, it hurts every month. The loss reappears again and again, at the supermarket checkout, on the credit card statement, when paying rent. Upon reviewing your insurance policy, the budget doesn't balance. So when someone says the economy is strong, the average American isn't asking about GDP. He is asking, if it's so strong, why am I using more credit? If it's so strong, why am I saving less? If it's so strong, why does my life require even more sacrifice to appear the same? And this is where the division becomes even clearer. The American economy doesn't reward everyone equally. It increasingly rewards those who already own assets. And it increasingly punishes those who depend solely on their own labor to survive. Assets are things that can increase in value over time or generate income, a house, a property for rent, actions, funds, equity investments in companies, land, capital invested. If you own assets, a portion of the economy works for you. If you don't own assets, you work to participate in the economy. This difference seems small at first, but over time it becomes an abyss. Imagine two families. The first family bought a house years ago, before prices skyrocketed and interest rates soared. They have an old mortgage with a low interest rate. The monthly payment is relatively predictable. Meanwhile, the value of the house has increased. Perhaps this family also owns stocks, has a growing retirement plan, and has some money invested. For this family, the economy may actually seem strong. The house increased in value, the market went up, net worth increased. The old debt became cheaper compared to current interest rates. Now imagine a second family. She pays rent, trying to buy your first house, but prices are high. Interest rates are high, The necessary entrance is out of reach. Insurance is more expensive. Car financing is more expensive. Credit cards are more expensive. Food is more expensive. This family may have jobs. He may even have received a raise, but she doesn't feel any progress. She feels persecuted. Every month, some bill goes up. Every month, the money runs out earlier. Every month, the future seems a little further away. It's the same economy, but it's not the same experience. This is the central division that almost no one wants to put in the headlines. The United States has not only become more expensive, it's become more expensive not to be rich yet. It ended up being more expensive not to have bought a house sooner. It became more expensive not to have enough shares. It has become more expensive to rely on rent. It has become more expensive to need credit. It has become more expensive to start adult life. It has become more expensive to start a family. It has become more expensive to make any financial mistake, and this changes people's behavior. When someone already has assets, inflation can hurt, but part of that impact is offset by the appreciation of those assets. But when someone lives on a salary, inflation is a direct pressure. The salary arrives once or twice a month. The bills arrive every day. And when bills rise faster than the actual rent, people start making small cutbacks. First, cut restaurants. Then, cut the leisure time. Then, cut back on travel. Then, cut savings. Then, they start using credit cards. Then, you start paying only the minimum. Then, things start to get delayed. From the outside, everything might seem normal. The person continues working, keep buying food. He's still paying for the car. It continues to maintain an appearance of stability. But internally, the budget is bleeding. This is the point that makes this crisis so confusing. It doesn't seem like a classic crisis. It's not a sudden break, it's a slow compression. The asset owner's economy may be expanding, while the worker's economy is shrinking. And that's why so many people get angry when they hear that the American consumer remains strong. Because often the consumer is not strong enough. He's only indebted enough to keep operating. There's a reason why American consumption still seems strong, and that reason isn't always a good one. When people look at consumption data, they think, if Americans are still spending, then they must be doing well. But that's only half the truth, because not all spending is a sign of trust. Sometimes, spending is a sign of survival. There is a huge difference between buying because you are optimistic and buying because you have no choice. Buying a trip because your income has increased is one thing. Buying more expensive food at the supermarket because you need to feed your family is another. Changing cars because you want comfort is one thing. Accepting expensive financing because you need to drive to work is another example. Using a credit card to take advantage of an opportunity is one thing. Using a credit card because your salary ran out before the end of the month is another example. But in the data, all of this often appears as consumption. And that's how fragility gets hidden. The consumer may seem strong until the moment he breaks. This is one of the most dangerous traps in today's economy. People continue to spend, but not necessarily because they are prospering. They continue spending because they need to keep their lives running. They need to pay rent. They need to buy food. They need to pay for insurance. They need to put in gasoline. They need to take care of their children. They need to go to the doctor. They need to pay for the car. They need to continue appearing stable, even when inside they are financially exhausted. And here's another point from behavioral economics: present bias. When a person is under pressure, they tend to prioritize today's problem, even if it creates a bigger problem tomorrow. If the choice is between putting food on the table now or worrying about the credit card bill in 30 days, many people choose to survive now, not because he is irresponsible, but because the pressure of the present is stronger than the threat of the future. Then comes the normality bias. People are slow to accept that their standard of living has fallen. At first, they think, it's just a phase. Then they think, things will get better next month. Then they think, when interest rates fall, it will ease the pressure. Then they think, when I get a raise, I'll deal with it. Meanwhile, they adapt to a smaller life without realizing it. Less savings, less leisure, less security, more installments, more debt, more anxiety. And there's also the social comparison. On social media, Everyone seems to be doing well. Everyone seems to be traveling. Everyone seems to be buying. Everyone seems to win. So many people feel ashamed to admit that their financial situation is getting worse. They don't want to look like failures. They don't mean that the salary no longer covers what it used to. They don't want to admit that the credit card has become an extension of their income. So they continue consuming, they continue smiling, they continue pretending everything is normal. This is the economy of shame, an economy where millions of people are financially strapped but feel they need to appear well. And that's why focusing solely on consumption can be misleading. Because a healthy economy has consumption sustained by rent, savings, and confidence. But a pressured economy can have consumption sustained by credit, necessity, and fear of being left behind. From the outside, the two scenarios look similar. Inside, they are completely different. And when consumption is sustained by debt, it is not a force. It's delaying the problem. The crisis has not disappeared. It became a monthly installment. It appears on the car payment form. It appears in a rental agreement. It appears as not secure. It appears in the supermarket. It appears as the minimum amount on your credit card statement. It becomes apparent when you realize you're paying more to live the same life. And that explains why so many people feel they are being deceived. Because people aren't just angry because prices have gone up. They are annoyed because, while life gets harder, they keep hearing that everything is fine. They turn on the television and hear that the economy is strong. They open a news article and see that the market hit a record high. They hear authorities saying that inflation is under control. Analysts are saying that the American consumer remains resilient. But then they close their laptops, get in the car, stop at the supermarket, look at their credit card bill, pay their insurance, try to renew their lease, and realize that real life doesn't match the headlines. And when personal experience contradicts the official narrative, distrust is born. The person starts to think, are they hiding something? Were the numbers manipulated? Am I bad with money? Is everyone else doing well except me? And the answer is more complex. You're not crazy. You're not necessarily irresponsible just because your salary isn't stretching as much as it used to. You are not weak because you feel anxious when you look at the bills. You're not ignorant because you look at a strong economy and can't see that same strength within your own home. But it's also important to say one thing clearly. Personal budgeting matters. Cutting waste matters. Planning your expenses is important. Avoiding bad debt matters. Financial awareness matters. But you can't solve a structural problem with budget tips alone. There is a difference between spending poorly and living within a system where housing, healthcare, transportation, food, insurance, and credit have all become expensive at the same time. Personal financial advice tells you to skip the coffee. Macroeconomics explains why housing, cars, insurance, food, debt, and medical care have all become more expensive together. That's the difference. It's not that small decisions don't matter. They matter, but they don't explain everything. Because if millions of people, in different states, with different professions, different ages, and different lifestyles are saying the same thing, perhaps the problem isn't just individual. Perhaps there is more pressure happening from below. And this pressure is invisible until it shows up in the monthly budget. If this explanation is finally making economics make sense, like the video. And comment below if your salary seems stronger, weaker, or exactly the same as it was a few years ago. Because that's the question that aggregate numbers don't answer. They show the economy, but you show real life. The real risk going forward isn't just a huge economic boom happening all at once. The risk is more silent. It's about the economy continuing to look good enough for people to ignore the damage that's accumulating underneath. First, people use their savings. Then they use the card. Then they refinance something. Then, they delay paying a small bill. Then, they delay paying a larger bill. Then, they have to choose between paying off debt, insurance, rent, medicine, or food. And for a while, it doesn't seem like a national crisis. It just seems like millions of private crises are happening at the same time. A family here, a worker over there, a couple postponing having children, a young man giving up on buying a house, a retiree returning to work, a mother using a credit card to buy groceries, a father accepting overtime just to break even. This is how an economy can appear stable in aggregate but unstable in real life. The danger isn't that all the numbers will break down at once. The danger is that the numbers will remain good long enough for people to ignore the damage happening underneath. So, when someone says that the American economy is strong, the right question isn't simply strong or weak. The right question is strong for whom? Because an economy can grow while your life shrinks. The stock market may hit record highs while your savings account disappears. GDP may rise while the dignity of millions of families declines. Corporate profits can remain high while ordinary workers have to choose between paying their credit card bill, rent, car insurance, or medical bill. And that's why so many Americans no longer believe the headlines. Not because everyone is pessimistic, not because everyone is bad with money, not because everyone is inventing suffering. But that's because there's a huge difference between the savings measured by graphs and the savings experienced in a monthly budget. In the graph, the economy is represented by a line. In real life, the economy is a decision. It's a matter of deciding whether you go to the doctor now or wait another month. It's about deciding whether to buy cheaper food even though you know it's not what you wanted for your family. It's a matter of deciding whether to pay the entire credit card bill or just the minimum amount. It's a matter of deciding whether to replace the car tire or risk a few more weeks. It's a decision about whether to save money for the future or just try to survive in the present. This is the part that the indicators don't show. They don't show any anxiety before opening the banking app. They show no shame in saying no to an invitation because they don't have the money. They don't show the frustration of working more and feeling like they're walking on a treadmill. They don't show the weariness of doing everything right and still feeling that stability is slipping further away. For a long time, Americans believed in a simple promise: work hard, be responsible, pay your bills, build your life, and things will get better in time. But today, for many people, that promise seems broken. Because hard work is still necessary, but that no longer seems enough. And when a society reaches that point, the conversation ceases to be solely about economics. She becomes emotional, turns social, it becomes politics. It turns into a crisis of confidence, because if people no longer believe that effort leads to stability, they start looking for answers elsewhere. Some will blame a political party, others will blame a generation. Others will blame immigrants, corporations, banks, the government, China, Wall Street, or any easily understood enemy. But the reality is more profound. The system spent years rewarding assets more than salaries. He spent years treating cheap debt as if it were real growth. For years, it pushed families to finance a lifestyle that could previously have been paid for with income. He spent years measuring force from top to bottom, while pressure increased from bottom to top. And now millions of people are feeling the result. Not as an economic theory, but it's like a more expensive life. A tighter life, a life with less room for error. A life where the same salary buys less peace. So, the next time you hear that the economy is strong, remember this: the economy is not just one thing. There is an economy of asset owners. There is the workers' economy. There is the investor economy. There is an economy for those in debt. There is the savings for those who bought a house before interest rates went up. And then there's the economy of those who are just trying to get started. They all exist at the same time, but not everyone experiences the same reality. That's why the economy can seem strong, and yet Americans may be getting poorer. Because strength is being measured at the top, and the pain is being felt at the base. The big question isn't whether all the numbers will break tomorrow. The big question is how long an economy can appear healthy while so many families are becoming more fragile on the inside. Tell me in the comments, do you feel like you're truly making financial progress, or do you feel like you're just paying more to live the same life? If this video helped you understand what's going on, please leave a like. And if you want to understand the next big risk growing beneath the economy, watch the video that's playing on your screen right now.